Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, September 2nd. Just before the close, heading into three-day weekend, ugly action this afternoon, ugly action all week. It's one of those rare periods over, say, the last 2 weeks or 15 trading sessions where it's been difficult to find anywhere to make money, right? Fixed income off, equity off, commodities down. Tricky. Just cash. When you see all asset classes under pressure, it tells you money's coming out of the market, coming out of risk into cash. That's the bad news at the current time. Good news is that leads to opportunities. So what we try to look for on the equity side in these type of markets is what's trading well, what's going down less, what's showing relative strength. And you hear me use that term over and over. So over the last week or two, we have seen an increase in relative strength from defense names. We're long those in the U.S. equity portfolio. We're actually long a large size there, 10, 11, 12% position. Those are the Lockheed Martins of the world, General Dynamics, Raytheon. Trading pretty well, certainly down with the market, but trading well above the lows earlier this year and off a series of higher lows. One of the biggest things we need to do, and you've also heard me discuss this in the past, is concentrate on our psychology in trading. Again, whether it's commodities, whether it's fixed income, whether it's equities, or a combination of all. Remember back in early August, markets were trading very well. I guess it was August 10th or 11th on our video. We talked about the fact that weekly momentum had gotten up to a level that often is a point we need to be careful. And I want to bring a chart up right here. And what this is a percent of stocks on the New York Stock Exchange trade and where they are trading from a weekly momentum standpoint. In other words, what percent of stocks on the New York Stock Exchange are trading with positive weekly momentum? You can see that spike back, 2.5, 3 weeks ago, where 88% of the stocks on the New York Stock Exchange were trading with positive momentum. That often goes hand in hand with an area where we've gotten overextended, where we need to take a pause, where the market has to digest some of those gains. We're in the midst of that right now. From a technical standpoint, all we've done is reverse ourselves in momentum, but we're currently trading above those May, June numbers. We'll see where the negative momentum goes to. Anytime we get under 30, or when less than 30% of the stocks that trade on the New York Stock Exchange are exhibiting positive momentum, we start to get interested at picking. Not very interested at 70, 80, 88. More interested as momentum starts to wane, and then we look for the reversal. You know, I talk about psychology. First 2 weeks of August, we had a number of calls from clients wanting in the market. Why are you holding cash? Wanting in the market. That is a symptom of emotion. And in terms of wanting in, as the opposite of wanting out in weak markets, is something you have to learn to control, we have to learn to control. It's part of trading. So we'll be looking at some of these areas, some of these sectors, some of these industries over the next week or two, keeping in mind in US ETF, boy, we're north of 35% in cash. In our tactical trend account, we're in the 24, 25% area. International, a little less, 12, 13, 14%. We do have cash, we do have dry powder, and we're going to get some nice opportunities. You know, a lot of bad news is out there right now, but you do have to stay flexible because some things will work. There'll be areas of the market, whether it's fixed income, commodities, or equities, that will be a good risk reward. So in terms of what we'll be looking for next week is to see what areas exhibit a little bit of relative strength. Where can we put some capital to work at a reasonable risk reward? Now we're going to go over to John Mousseau, who is taping remotely this week. Take it away, Moose.
Hi, it's Thursday afternoon on September 1st. I'm John Mousseau. I'm the President, CEO, and Director of Fixed Income at Cumberland Advisors. This week in bonds, we're doing a little early today because I'm going to be off tomorrow. But look at a week, tough week for bonds. You're looking at basically the 5, 10, and 30-year bonds, all up about 20 basis points. So call it a 340, 326, 338 in the 5, 10, and 30-year range. So bad week. Why? Well, continuing fear of what we heard at Jackson Hole. So that the Fed is going to be proactive, continuing to raise rates, vigilant on inflation. That was the message the market got out of Jay Powell. They clearly haven't liked it. The stock market hasn't liked it. The bond market has not liked it. But you have to review this in the bigger concept of where we have come. Those yields on those bonds are still basically below where they were in June. I think that says a lot. We'll watch and see whether these yields make new highs. They could, but they have stayed pretty much in that broad, call it the 10-year range, 275 to 325. We're a little outside of that right now. But we've seen other time periods where they've gone a little higher. So we're going to watch that. Muni yields this week, pretty well behaved. They were only up about half as much as Treasuries were. A couple reasons for that. One, they're already cheap. We know that. We've talked about it. Also, the calendar this year is down. So we're not seeing the issuance that we had. We think that muni bonds are still a tremendous buy. Let's look at two charts here. Let's look at the 10-year bond chart. And we can go back and we can see how it rose right through June, certainly declined till we got to this part of August and has risen since, but we're not back to where we were. That's one chart. The other chart, we're looking at the break-even inflation rates. We've talked about these before. And the break-even inflation rates is merely the difference between the yield, for example, on a 5-year Treasury inflation index bonds, the real yield, and the nominal yield on a 5-year U.S. Treasury bond. The difference between the two is the break-even inflation rate. That is the market-derived rate. Above that rate, you would have been better off in basically an inflation index bond if inflation was higher than that rate. And if inflation was less than that rate, you would have been better off in a nominal 5-year bond. Those rates have dropped from where they were earlier this year at 3.5. They're down closer to 2.5 now, 260. Does that mean anything? Not really, but what it does tell us is that the market's expectation of longer-term inflation, and you can see both 5 and 10 years on that chart, has dropped, and with good reasons. The background noise, in spite of what the Fed is doing, is still of a slowing economy, whether you want to talk about real estate, with price cuts in many cities now going on, commodity prices dropping, energy prices dropping, starting to see job cuts. We saw the news in the past week at both Wayfair and at Snap, yes, technology companies, but clearly shedding jobs. So basically, as the Fed is raising rates and making the markets feel their pain, the backdrop is that the economy is losing some of the wealth effect that it got from the pandemic with all the federal money going into people's pockets. That's behind us, not in front of us. So we think that certainly muni bonds continue to be a very good buy, particularly on the long end. And to the extent that spread product, things like taxable munis and corporates, which come at pretty decent spreads over Treasuries, those are attractive. It's the reason we continue to manage portfolios in a barbell method with a shorter term and longer term and moving some of that barbell out. We think the Fed's still got plenty of work they're going to be doing, but they're doing it with an economy, and we'll know more tomorrow from the jobs number, that continues to slow a little bit. All right, we hope everybody has a great Labor Day weekend, and we'll see you next week. Thanks a lot.
Thanks, John. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. We'll see you next Friday.